Welcome to China Tech Talk, the almost weekly discussion of technology and startups here in China. I am John Artman, joined as always by Matthew Brennan, founder of China Channel. So this week we welcome Shai Oster back onto the show. Previously we had him on to talk about Xiaomi's upcoming, and of course now already finished IPO. And so we brought him on to talk about IPOs again. Shai's proven to be extremely knowledgeable about these types of topics, and obviously because of his work, he actually talks with a lot of these companies directly, and so he's able to provide a lot of insight into why companies are going IPO in a bear market, but then also specifically how the market's been reacting and some of the background behind some of the fundraisings. That's exactly right, John.
At the beginning you said almost weekly podcast. Is that what we are now? An almost weekly podcast?
I mean, you gotta reflect reality, and the reality is that we don't always post every week, unfortunately.
It's really tough, isn't it? Yeah. I mean, we've been going for quite some time now, and I think we've kept with it. I'm proud that we have kept with the podcast for so long, but it is tough to do it every week. I agree.
Exactly, and I think our listeners have been fairly forgiving. We still get a lot of really good feedback, and to be honest, I mean, now we're kind of navel gazing a little bit, but also I think the way that we've structured the podcast has worked out really well, because it's not always timely. But it's always very topical, and so I've gotten feedback from some listeners who use us as a way to do research, and so when they listen isn't so important. I think the important thing is that we have this information out there for them.
Sure, yeah, and today, so it's our second time to have Shai on the podcast, right? It was when did we last have him, John? It was quite a while back, right?
It was a while back, yeah, before the Xiaomi IPO.
Yeah, and back then we were also covering market dynamics. That's what the information I think is good at. This sort of blend of technology and finance, business analyzing them as businesses rather. And yeah, the IPO market's been exceptionally busy for Chinese tech this year. There's lots to talk about. We cover Meituan. We cover a little bit about bike sharing. We look at potential forthcoming IPOs with Bytedance, with Ant Financial. We look at Tencent Music. What else did we cover?
Pinduoduo as well. We talk a little bit about Xiaomi. We touched upon NIO, the electric vehicle company. And in general, I mean, it was just a really great kind of wide sweeping discussion about these companies that have gone public.
Yeah, definitely. So without further ado, shall we get into it?
All right. Well, Shai, thanks so much for taking the time again to join us this week. So we had you on previously, and we don't want to rehash some of the information that you gave us about yourself. And so if listeners do want to have more information about you and kind of what you do and some of your background, they can listen to that episode. But of course, we do want an update because it's been 6 or 8 months since we last spoke. I know the information is growing, and you guys are doing a lot more events and things like that. So why don't you give us an update?
Yeah, so actually today is in the U.S., it's our 5th anniversary for the information. We actually celebrated it here yesterday, December 4th. And we're really excited. We just announced the hire of another reporter. We're opening a Washington, D.C. bureau. So we're going to be expanding our coverage into policy in DC. So, that's great. And I'm up to 4 reporters here in Hong Kong. We had a subscriber summit in November where we featured some of the top. We sort of focused on bringing women to the stage. And we had an amazing lineup of top venture capitalists. Annabelle Long from Bertelsmann. She's been investing for about a decade. The $1 billion that she's put in, including some of the top performers like Kuaishou. That's Ruby Loof, who was a co-founder of DCM, now launching her own shop. as well as we had General Atlantic's head of TMT. We had the head of marketing for Uber Eats, which was really interesting. And we also had some really interesting entrepreneurs on stage as well. So we've been doing well, and we're looking to maybe do some more events in Hong Kong around cyber, cryptocurrencies, which will, it's even though the market, as the market's tanking, probably makes it an even more fertile and interesting time to be writing about it. And yeah, so we've been having fun, been doing some good stories. I know we're doing well because people are annoyed by us. So we must be doing something right. I especially like it when people are annoyed by us, but then they keep talking to us. That means that at least we're being fair when we write our stories. So that's always a good sign up. It's an interesting time to be doing this, and we're I think getting some good traction out here in Asia with this team that I have going. Cool. And so you should subscribe. You should always subscribe. The information. 50th anniversary promotion. Subscribe now. You get amazing deals. Subscribe. Theinformation.com. Just have to do my speech. All right. Thanks. Sorry for that.
Nice. So yeah. As long as there's a deal, that's what really drives those conversions. So I'm just kind of curious, and so we want to talk about IPOs, but you just mentioned Uber Eats, and I've been seeing a lot of ads for Uber Eats in my YouTube feed, and I'm just wondering, are they doing well in Hong Kong?
They're doing okay in Hong Kong. Hong Kong is not the most amazing. Hong Kong is a very competitive market for the food delivery. The places they're doing well would be Australia and other parts of Southeast Asia. They're doing pretty well in India, and they're making a push in Japan. And what's interesting about Uber Eats is it gives them a presence in markets where they don't have the ride-hailing services, and so they can plant the flag in countries. And it's kind of, it can be a profitable business, especially in places like Australia where they already have the existing driver base, where it's really drivers who, when they're in downtime, can pick up and drop off food. But in places like Hong Kong, you have to have a separate, guys on motorcycles, sort of like what you see in China with the people delivering Meituan or Ulama. But it's actually a pretty solid business globally for them, which I was surprised to hear. I expected it to be just a loss leader, but they seem to be pretty excited about it. They expect a lot more growth, particularly in India. They said exponentially is what they say in India, and that's an interesting thing, because India, you don't think of you think of mega cities clogged with traffic, and if you saw the movie, they have the whole tiffin delivery system in sort of these homegrown network of guys who deliver. So wives will cook food for their husbands at work, and there's this network of guys who will deliver the food from home to the office. But I guess as things change in India, emerging middle class and all that, there's more of a commercial food delivery business, and Uber is able to tap into that, which I was surprised that they were able to get a toehold in that kind of market.
Mm-hmm. Yeah, because it's kind of like China. It is kind of like China in that sense. The delivery market's already it's maturing, right?
Yeah, but the Uber CEO, so they think that the Uber Eats will be as big as the ride business. So it's wow. Yeah, and that says a lot. And again, it's also it's customer acquisition. I get you on the food that you do, and eventually I might be able to get you on the rides. Whether the hurdle is regulatory or just sort of building out the system. For some reason, I think there are much fewer hurdles when it comes to delivering a hamburger than there is to delivering a person. Plus, there's no existing, almost every city has an entrenched interest in the taxi fleet, the local taxi fleet. And those are often highly regulated, have close ties to the government or the mafia. Food delivery, because it's new for everybody, is less of an entrenched interest that local governments want to protect, right? It's not like, I don't think that Shanghai government's we must be close with Meituan, right? Whatever, right? It's not the way the taxi fleet is. It's not seen as a socially crucial business.
I guess that leads nicely into we could talk about the first IPO from this year, which would be Meituan, right? They IPO'd very recently. They had their first earnings call a week ago or something like that. How has that gone in your mind for Meituan, and what's been the reception? What's been that ride of them going from through that process?
So they raised over $4 billion, which ain't bad. And now what they can do is they can borrow money much more cheaply for the continued fight. That's the thing that people, there's sort of like right now I'm just looking at their share price, right? Year to date, okay, so they're below their IPO price, right? They IPO'd at 72 Hong Kong dollars. They're trading now at quite sharply down. It's 53. So it sucks if you're a last investor and your ratchet clause wasn't good, so maybe your investment is underwater. But you probably have a long holding period anyway, so you'll hold on to it for a while. But there's a couple of things. So this to keep into account. So one is that now, the next time Meituan wants to raise money, it's a much easier process because it's not a private company. As a listed company, banks are much more comfortable because your finances are publicly audited. You're held accountable to the SEC. There are consequences if you lie. So they can very easily borrow money offshore from a much broader array of banks and borrowing money is always cheaper than selling equity, right? If you're a private company, the way you raise money is you keep having to sell pieces of yourself to get cash, and that's kind of an expensive process, right? Like you're literally cutting off your arm to grow, whereas just borrowing money is a lot easier, and banks are just generally more comfortable lending to listed companies because of the transparency there. And the banks, while they care about your share price, they're going to, because maybe you do some sort of, you can use your share prices as collateral or whatever, but they also will look at the health of the company. And the revenue is there, right? Meituan does have cash flow. It has losses, but it has cash flow. And so that will allow them to kind of, perhaps the thinking is it's a more sustainable way to keep getting cash for this fight that they're engaged in, for market share versus Ulama. So I think that even though it looks like on one level, oh my gosh, they're below the IPO price. Yeah, well, that's what, share prices aren't static, right? There's a chance that it'll move back up if they reduce their losses. And also in this case, the losses, like profit, always remember, like profit is the one thing that you can fudge the most. It's the one thing that you can kind of control, especially in these business models where it's like heavily dependent on subsidizing. If they need to goose the numbers, they can reduce the number of subsidies or discounts or whatever else that they offer, and it can be like, oh, look, we're profitable. You can have a higher profit margin relatively easily. It might mean that you have a smaller market share, or it might have some other consequences. But the profits are sort of, to me, the most variable, the most mushy number in companies, because it's, is your operating profit, is the whole company profitable? Like you could look at, is their core food delivery profitable versus, they have this expensive, the bike sharing, the bike riding business, I think is a big money pit, which they can spin off or whatever, right? And also some of the losses are the result of how they accounted certain stock incentives as well. So I'd still look at them, they listed, right? So people got an exit, which is also, in one way, is a very positive sign. And it's trading down, but I would still think of this as, yeah, sure, if you're a short-term trader, this is terrible. But I think if you believe long-term in the health of the company, this is a better option. It's a better route for them in the long term. It's more sustainable.
But I feel like that can be said about almost all the IPOs that we've seen from China this year. Xiaomi hasn't done very well. Pinduoduo hasn't done very well. So I guess, and that's kind of like the overarching topic that we wanted to touch upon was, so what really kind of kicked this off? What really kind of kicked off the IPO frenzy, if you want to call it that, was China Literature that was earlier this year, and then we've seen Tencent companies go public after that, and then of course culminating most recently with Tencent Music filing just the other day in New York. But that's kind of like the big question. So obviously, for longer term investors, maybe it's not so big of a deal. But tech IPOs, they're usually worth a lot of money. And if you want to really maximize the amount of cash you're able to raise as a company, or the size of the exit as an investor, isn't going public in a bear market not a great idea?
Yeah, it's not the best idea, but there's two things. The process for an IPO takes 6 months, at least. It's not something you can do at the turn of a dime. And a lot of companies, I actually was talking to a company that's in the process of preparing the IPO, and I asked them that question. They said, well, look, this train left the station 6 months ago, and it's very hard to stop it. And in some ways, it's worse to say, okay, we're not going to go to the market. It's actually more potentially damaging to the company to not IPO, because then everybody loses confidence, and then you face the prospect of a down round, perhaps, which is also can be very demoralizing. So part of it is just like companies started the process when the markets were just looking pretty good. It's just kind of hard to turn that boat around at this late stage of the game. The other thing is that this is a bear market, but there are a lot of indications that it's going to be a much worse market in the next coming months, right? The trade war isn't going away, right? It's up one day, it's down the next. No one knows what's going on with Trump and Xi Jinping. It's just a mess, right? So that uncertainty is going to continue for a long time. Plus, there are other indications of like tightening in China, right? Credit's getting harder, although there might be another stimulus, but no one knows really what's going on with that. And overall, tech is no longer the hot flavor, right, in the U.S. either. And so, that window is almost closed at this point, I think. So people are thinking, all right, well, it's better. We can still get a solid exit. It's better than like a disastrous no exit, right? Because also there's like a lot of people, you're still getting cash out, right? And you have to also kind of reward your employees and all that. So there still is some upside, even if the market performance after the IPO might be a more modest one. But I think people are sort of thinking like, we better do it now, because the next opportunity is there's just no clarity, right? You don't know, like this has been like a 10-year bull run, right? It's got to end. It looks like it's ending now. We don't know how long the bear run's going to be for. So it looks like at least we're catching it in on the way down, but not in the valley.
Yeah, I mean, it is. I mean, it's interesting that so a lot of it sounds like it's kind of about momentum, and so there's a lot of psychology involved in terms of when's the best time, and not deciding not to pull the trigger could cause other problems. But at the same time, you have. Like Lei Jun, for example, he had to make public. He's a very public person, but he was being very clear with his staff, saying that the bear market has nothing to do with the company. That it's all about the share price. It's all about the markets, and like the company is worth a lot of money, and so on and so on. But so for like a company like Xiaomi, who's eking out these really small margins. I mean, do you think like their lackluster IPO affected their business at all, or is it kind of like what you were saying? It's just that it's just it's the best time to do it, and it's not really kind of in the grand scheme of things. It's not really that big of a deal.
So Xiaomi, is a weird one, right? Because they say that they're a smartphone company that told everybody that don't look at our major source of revenue. We're actually an internet company. And the market said, well no, you're not. You're a smartphone company. And then it turns out they actually did pretty well in some of the numbers, right? They had really good sales of smartphones, so they should just focus on that. And I think also, the initial numbers of 100 billion valuation that the bankers were floating around, it's unclear. I've heard both people say that it was what Lei Jun was wanting, $100 billion valuation. Also the bankers, the bigger the IPO, the bigger everybody's commission is. So there was a lot of incentive to inflate the number back then. And so, plus they had this extra kick in the shins because they were going to do this domestic offering at the same time, into that pilot project to bring overseas Chinese companies or overseas listed Chinese companies back into domestic markets. And that fell apart. There was just a lot of factors for Xiaomi, that are a lot of headwinds, right? Plus the overall sentiment was changing. So I think, but that contributed to their particular problems, contributed to the overall sentiment as well, right? So like, well, look at Xiaomi. You can't explain, it sort of cast a shadow on the subsequent IPOs. That said, though, every company is different, right? Like Xiaomi smartphones is different from a Meituan services, right? Is different from a Pinduoduo. Well, Pinduoduo is in the same bucket, but then if you look at like the peer lenders, right? They're a disaster, right? And that's just like, because they're square in the crosshairs of the regulatory, of the Chinese regulators, right? And they also shot themselves in the foot a lot with how they presented themselves. I think also, just to go back to Xiaomi for a second, I felt that the messaging was really muddled. It was just very confusing what they were trying to tell investors, and that contributed to it. But does that share price impact their performance? Not as far as I've heard, because it's not like, it's not like in China when you had somebody like a Echo, where the founder borrowed $1 zillion on using his shares as collateral, and then when the share price turned down, the founder, there was a margin call and everything collapses. That doesn't seem to, that you just really can't do that in the offshore markets. Plus, these companies are structured in a way where the founders still retain control, even though they're listed, right? Because of the dual class share structures that were allowed in Hong Kong and the ones that exist already in the US. So I don't think these companies are in any danger of like an activist shareholder coming in and seizing a position that forces out the management or anything like that.
I mean, what you mentioned there about the timing really makes a lot of sense. I mean, I just wanted to draw attention to like the Tencent Music one, because for them, they actually delayed the date, right? They put the thing on hold and then didn't give any indication of when they were actually going to file properly, and now they've just filed. So, like, what was why did they stall that? If you could just elaborate upon the points you've already given, like what. Was that risky for them to do in terms of doing something like that? And I don't think we saw too many others just suddenly say that pause it and then change the date with very, very short notice like that.
I honestly don't have an inside track on that, on the Tencent IPO. It is unusual to kind of last minute hold off, and they're coming in at a half of what they initially hoped to raise. I guess they were targeting $2 billion and they went up with $1 billion. But I don't think they. The other thing is that the fact that it was put on hold was kind of never confirmed by the company. So who knows what internally was going on? There could be a million other reasons. I think, though, I'm trying to think, looking back, they had, they actually had some, it could, yeah, I don't understand that. I don't know how traders will react, or if they care that there was a delay, frankly, right? Because for them, it's kind of, there's a million reasons why you can postpone something. And I think also they want some distance between their share offering and what's going on with Tencent, the parent company, because they kind of got, there was all this bad news coming out of Ali and Tencent, and so maybe they just wanted a little bit of a breather between that so people can digest that news separately. So it's unclear to me what was going on there. I do think, though, that now is actually a much better time to do it because there's sort of a glimmer of hope in the trade war, and so you might have a more firm sentiment, but yeah, I just don't have enough clarity to or insight into that particular one. I do think it's an interesting IPO, though, because they can point to Spotify, and while their margins are nowhere near Spotify, because they charge obviously for the Chinese market much less, their addressable market is huge, and they have their funnel is WeChat, right? So that's a billion potential clients or customers. So it's still, it's still $1 billion. Raising $1 billion is fine. And again, like, they now, once they've gone to market, they can now raise debt very easily. So I think it's kind of, sorry to give you such a muddled answer.
Yeah, I think it is an interesting IPO. You're right. Like it's profitable, right? So like it does get compared to Spotify, but user acquisition costs are much lower due to WeChat, right? And then, but the paying ratios are still really low. Whereas Spotify does really, really good on like getting their users to convert. But Chinese won't pay for music, most people still today. And so that's why entertainment is so much more important for them, live stream and things like that. But it's one of the few IPOs that's like clearly profitable, even though it's not it's still like, as you said, compared to the global market, still fairly early days for online music as a business in the mainland.
Yeah, no, they claim 800 million monthly active users, which is kind of insane. The other interesting thing is that Spotify owns about 9% of Tencent Music, which points to some interesting, synergies in the future. But the delay and then decision to move ahead, I don't know if that means they think things are just going to get worse. It was funny. So in the boom days, when everybody was getting these insane private market valuations, it always felt like the public market was the market for suckers. It was like you do these private rounds where each round is like 10x the previous round and 15x or 1000x or whatever, and then we're going to pick some insane number for our valuation to IPO because, well, the public markets, they're just fools, right? It's just, that was the feeling you had from both entrepreneurs and from private market investors, that like they were the smart money, and the institutional investors who are playing the stock market, well, they just read a spreadsheet. They're just the dumb money. So we'll just whatever, right? We'll show them amazing growth and dump these turkeys on them, exit, and all will be good. But it turns out that the public markets are filled with pretty savvy, sometimes savvy investors who are like, no, these are turkeys. We don't buy it. And so, I don't know. I feel like there was part of the reason why all these stocks are coming down is that maybe the suckers were the private markets. Maybe they were the ones who were overpaying for these companies, and they should have been much more aggressive in demanding like more reasonable. Like it seemed like, you got the feeling that sometimes these valuations were just like an entrepreneur would pull a number out of a hat and be like, oh yeah, we're worth $5 billion. Okay, sure, right? Because there was so much frenzy. There's because the funny thing is the private markets are a tiny number of investors, really, especially in China. There's like a handful, about 10 top tier VC, right? And there's this real herd mentality people complain about. I've heard other investors complain about. There's like a herd mentality, and there's a fear of missing out. And so if there's a feeling that like, well, there's a lot of junk out there, and the ones that are good, we all need to pile in. And so you're willing to pay any price to pile into the one that's going to get that you think is the winner, right? And there's certain brand names that if they're attached to a project, attract a lot of capital, right? And so I can easily see what happened was that like, we're not looking at like companies coming down or being undervalued, but companies being properly valued, right? So that what we're looking at here is a correction from the insanity of the private markets. Once they list, there's a whole bunch of there's a much broader pool of investors who all are running giant pension funds and hedge funds, and they're not playing with their money. This is serious money. These are very sharp people who have to like pay, they have real clients and obligations. And, they're just not going to buy it. There was a lot of also private wealth that was involved in the private market. So like family offices were coming in at late stage growth capital, I think. And I don't know the percentage, but I think some of that was very sophisticated family offices and some of it was less sophisticated. There was a lot of syndication of like these late stage, these big rounds at the end. And you could see where there's a lot of incentives for everybody to like pump up the value. There wasn't a lot of incentive for people to say, hold on, maybe we're not a $45 billion company. Maybe we're really a $30 billion or a $15 billion company. There was nobody, when you're doing these private rounds, who's there to say like, hold on, like, wait. But then when it comes to the public markets, it's much less like you can suddenly be shorted, right? Like there's much more of a give and take. So maybe that's what happened, is we're actually just seeing the results of like, this is what happens when you have too hot of a private equity market and it's suddenly colliding with the cold reality of the public markets.
I mean, do you think that's a function of just more information being available about China? Like I remember years ago, I used to listen to some investment podcasts, and they would talk about some Chinese stocks, but it was always kind of like they were always a bit wary, and to be honest, they never really seemed like very too well informed. So it could of course just been those personalities specifically. But I'm kind of curious, I mean, because like you look at Pinduoduo, for example, and they filed, they went public, and that's when everyone piled on about the counterfeits and about the problems on the platform. And so it seems like that's part of that's colliding with reality, as you put it. But then also, I mean, I have to wonder, why wasn't that information kind of made more public beforehand? And how much of that was a function of just there being more information about Chinese companies and kind of maybe even people being able to source information much easier than maybe, let's say, 5-10 years ago?
I don't know. So, in the case of like, there's another famous large company that still has problems with fakes, and that doesn't seem to slow them down much, right? Alibaba, right? The Alibaba IPO there was definitely like the same issues, and investors honestly don't give a hoot about your fakes, right? They're like, well, as long as you're selling stuff, it's fine, right? They're not, right? There's not a lot of ethics, and I mean that's not true. I don't want to be too harsh, but there are other e-commerce platforms that have struggled with the question of fakes, and I don't think that's really Pinduoduo's issue here. I think Pinduoduo's issue is more about like, is their form of this quote unquote like this tuan, it's kind of like group, it's sort of a Groupon in a sense. And people, I think what their problem is that people looked at it and said like, well, wait a second, aren't you just kind of like Groupon? And didn't Groupon like struggle? Like, how are you going to reinvent Groupon in a way that will survive against Alibaba? I think that's more the concern they face. The fact that they have fakes on the platform, I don't think is an issue. I think I know for a fact that competitors were feeding that story, for sure. There were some legitimate issues there. Like there was the guy, I love the story, like the diaper maker. There's the Chinese domestic brand of diapers who's filed a lawsuit in the U.S. because Pinduoduo was abetting, he alleged was abetting the sale of knockoffs. And I love that story because it's Chinese copying Chinese goods, which shows you the rise of the Chinese brand, which is a whole other story that I'm fascinated by. But be that as it may, I don't think that's really what their issue was. Their issue was like the business model. Like, okay, because they talked a lot about, oh, well, the reason we're able to sell so cheaply is we do factory direct. But then what percentage of it is really factory direct? What percentage of it is actually from other merchants trying to offload goods for cheaply? And then this whole question of like, well, aren't you just in essence group buying? And isn't group buying kind of like a struggling model, right? Like, they argue that they're not, that they have all these other innovations and they're super smart, etc. But I think that's their problem, not the fakes. Now, as far as information goes, yeah, there's definitely more information. I mean, what you file in an IPO though should be the same. I think it's more. Yeah, more information. Thanks to outfits like us, the information people are, or you guys. There's definitely more journalists running around and more research houses, but also the caliber of the companies that are listing now, and the size of the listings are astronomical, right? Compared to a decade ago, right? A decade ago, China Tech, there was the previous generation, right, of when Tencent listed, and gosh, I don't remember what year Tencent listed, but Alibaba only listed, in recent history, and the companies that have been listing in the past, 2 years, are enormous, right? These sorts of the reason they have so much scrutiny is because they're coming in at these insane, they're huge, right? There just wasn't a Meituan. And you think about it, like, so it's not just like, oh, there's only Meituan, there's a Pinduoduo, which is coming in huge, right? Like, all of these companies are just so enormous that, of course, they're going to attract much more scrutiny because they're much more important, right? Like, the reason we gauge their value by the dollar sign we put on them, and we think they're really valuable, broadly speaking, right? Even though they're down once they IPO, they're still pretty valuable, even after they've come down. So that's why they attract so much more scrutiny. They are worth that scrutiny, so to speak.
Yeah, it makes total sense. And you have to remember, like, back before even there was a whole bunch of Chinese companies like doing reverse mergers, right? On a recent plane, there's a good movie about it, the China Hustle. I watched it on a plane journey like about a week ago, where there was a whole wave of Chinese companies that did reverse mergers in the States, and a lot of them were just completely not fake companies, but just lying about their numbers outright, and due to the way committing financial fraud with very little consequence. So there's a history there of suspicion about Chinese companies, I think.
Those were dogs. Those stank from a million miles away. It was so hilarious. The guys promoting them were sketchballs. There was a whole ecosystem of I remember somebody pitched me on these companies, and I was like, as a journalist, I'm like, I don't think I'm going to write about this because it's just like, you're sketchy. The company you're talking about is sketchy. It's like, meet me at the China Club on Pinduoduo, and there's like some random tall Russian lady with us, and I'm like, what? Not Pinduoduo, Chang'anjie, the Chang'an, whatever the Chang'an Club is. I remember, and there's like me with this Chinese stock or a Chinese investment banker who I look at, has like a sketchy history. And there's like this statuesque Russian blonde, and I'm like, I have no idea what she's here in this room for, other than as like a prop of some sort. I'm like, you are. So I don't understand why anybody put money in those, because it's like my sketchballometer was like, red alert, it was just weird, right? And also like the businesses that were listing, it's like, oh, we sell French fries. Like none of them, like, yeah, it was kind of right. You got to be kidding. And a company like Meituan, like, you can go and count the number of people on bikes riding around delivering Meituan food, right? Like, there's something there, right? You may argue that like their margins are in the pooper, or you may say that like the way they're acquiring customers is a disaster, and they're going to be in the red. But there's a business there, right? Like, you can see the business. It's a real business. You can gauge it, right? You can argue how much maybe they're inflating it in some way, but it's on the margins, right? Like, you can say, oh, it's not sustainable, or they make some strategic mistakes, but there is a there, right? The same is true for Didi, right? Like, there's a ton of people who use it. This for a fact, right? Like, there is some revenue. Or you could argue, are their margins going to collapse, or are they going to be regulated out of existence? Sure, but there is, again, a there. And so much of the stuff that was doing these reverse mergers, just by virtue of the fact that like everybody was doing it already, should have been a red alert. Like, why are a bunch of companies doing something that by its nature avoids scrutiny, right? When you do a reverse merger, your regulatory obligations are much lower than if you do an IPO. An IPO is saying to the SEC and to investors, hi, take a look, I'm going to open my kimono, stick your flashlight inside, and do your sorry, I'm trying not to be scatological, examine me very closely. Whereas a reverse merger kind of signals to the markets like, it's easier for me to take over somebody else who's dying and inject my assets into it than to actually subject myself to the scrutiny of an IPO.
Sure, but I think it leads into the point you're making earlier about like the dumb money, right? So for bringing up there, like the sort of extreme case of American stock markets kind of, being the dumb money, as it were.
So it depends. So, okay, like a lot of those reverse mergers are onto pink slips anyway, which is just like, whatever, like you want to play that market, that's a high risk market, fine. But then it's like, there's dumb money and there's like, I think I'm clever, right? There's like, okay, I know this is a dog. I think this happens a lot in financial markets more broadly. They're like, everybody knows it's a dog, but they know that everybody knows that everybody knows it's a dog. But it's like, you just don't want to be the last person holding the dog. You know what I mean? So like, this is a hot stock. I know it's a turd. So it's a game of hot potato. You just don't want to be the person holding you know what I mean? Like, so they'll buy it, hold it for whatever, and then sell it on, right? So that's the thing is like, you don't want, if the stock is rising, you don't care what the underlying is for a lot of people, right? The underlying doesn't matter. What matters is the stock price is going up. So screw it. Yeah, is this you know, to actually fight a rising share price is expensive. You got to short a stock. Shorting a stock costs you money. You got to borrow somebody's shares, and then if the share price keeps going up and you're short, it's going to cost you more to maintain that short position. And eventually, you know, even if the whole market is wrong and you're right, but the share price is still going up, you can be screwed, right? So it's much more risky to go against the market sometime, right? Even though, you know, I mean, that happens a lot where like, you know, everybody's like, this company doesn't count, like whatever. But like, you know what? I think there's somebody dumber than me who's going to buy these shares a week from now.
It sounds a lot like the herd mentality you just described of VCs, though.
Well, yeah, I mean that can happen, right? But they're smart. If you're moving in and out quickly enough, you can catch it, right? And that's also why, like, once the stock goes down, it's hard for it. Like, the sentiment can return, but I think it's again, there are broader factors at play that, like, all tech right now is kind of off flavor, right? Is risk. You know, no one's tech in general now is kind of not a popular investment. I think the IPO market, though, there was really this feeling that the dumb money was in the public markets, and they just weren't there this time. Yeah, I do sound like I contradict myself. You know, Walt Whitman, right? I contain multitudes. But like, you can be smart and know that you're playing a game, right? That's my point.
With Meituan, like, I think there's an interesting thing, like, so they assumed Mobike, right? So for the first time, we have like public numbers about Mobike or any kind of major bike share or bike rental company. They kind of merged it together in an others section, but it's quite clear that like this thing is losing a lot of money. And so that's a kind of a dynamic of what you're just describing about all the VCs piling in, not really being a sustainable business model. I think that the Mobike, the bike sharing is a great example of that. And now we've seen that, you know, that finally one of them has kind of semi-gone public. And then there's also a lot of, I think for Meituan, that's one of the key questions, right? Is like, there's two key questions maybe. One is like, what happens to bike sharing and what happens to ride sharing? Because it's quite clear that those two areas are not doing so well. And then the other one is like, how do you fight Alibaba when they've got much deeper pockets than you?
So the point on the bike sharing is really interesting, and I'm trying to figure it out now, because it seems that there was just value destruction on epic scale, right? I'm really, at the end of this, it'd be interesting to tally up the amount of money that was wasted on this, on what kind of looks like actually can be a viable business, right? It, again, like there was real revenue, there was a real business in this, and it just went nuts, right? Like like these bicycle graveyards, right? Like, this is just insane waste. And what surprises me is it's like, you know, people talk about like your capital efficiency, like that doesn't look very capital efficient, right? That's just like an insane waste of money to make bikes that are essentially disposable. And the venture capitalists were happy to keep funding this insane business model. And early on, I spoke to some people one investor who she'd looked at either a Mobike or OF, I forget which, and they had actually the team had put GPS trackers on the bikes surreptitiously in a couple of cities to actually track how often they were used, and they'd calculated the number of rides per day per bike you would need to make the money back on the bike, and they found that like these bikes just weren't being utilized at all, or at the level that they needed to make this a viable business. And plus, also they sort of figured out like what would be the saturation number of bikes per city, and just saw that this was quickly not going to be working, and so they'd stepped aside, and then. But for like a year or so, they looked like they made the wrong choice, right? And now they look smart because they didn't waste their investors' capital. But that said, I kind of wonder, like, what? Again, so with Meituan, there is a business logic behind buying the bike sharing fleet, in that you can kind of see there's some synergy, perhaps if the bikes are then used for the delivery guys, maybe. But I don't know. It's kind of weird to go in and buy this, and then at quite a high price, mind you, and then start doing the cutbacks once you're public. It's sort of like, there's some hard questions to be asked about, like, well, what was motivating the decision to buy it in the first place? Why was the price it was? And did they make a mistake? And then the question then is, so you have OFO kind of lingering around. You have Mobike. Ali can't, Ali is effectively represented by Hello Bike, which is growing as well. But then can Ali now in this environment start throwing money at it? I mean, it could be that, there's room for more than one bike sharing company, in China. It's a big place. And maybe it's just like, okay, we did this insane period. We're going to consolidate, rationalize, and then we'll have sustainable businesses. I mean, that's one option. I mean, but I think that there was this just crazy exuberance, and part of it was also driven by the bike rental companies. They're not really shared bikes, they're rented bikes. Part of the enthusiasm that investors had about them was that they were a way to acquire customers without having to pay a tax to Baidu or Alibaba or Tencent, right? And so in a sense it was like, well, our customer acquisition costs are pretty low, relatively speaking. And so that's why they were willing to make disposable bikes. But I think that's, obviously that hasn't worked out quite the way anyone had hoped.
So kind of getting back to more of the IPOs and things like that. There's two companies that really kind of stand out in terms of why now, and that's NIO, so Xiaomi, the electric bike company, and then NIO, the electric car company. And so rumor on the street was that NIO in particular, they went public because they were not able to get any more private funding, or perhaps if they were to get private funding, they would have to do a down round. And so because of that, they chose a public listing instead. I mean, do you give much credit to this type of theory, or is there something else kind of going on with these two companies?
So Xiaomi, I don't know very well. I actually would think, broadly speaking, now is a great time to be a scooter maker going public, because you stand a chance of competing against because there's a boom in the U.S., right? All these scooter companies, and if you become a supplier, and the whole model of bike rental turning into scooter rental, that looks like it has some legs, unexpected legs, and in a market where it's a richer market in the sense that your margins are probably going to be better doing this in the U.S. than in China, right?
Well, to be clear, so they're, when I say scooter, I mean like electric bike. They're like electric like what we used to call scooters. So they look kind of like a Vespa or a.
Yeah,
or a,
no, I know,
okay.
I know, but there's a lot of overlap, right?
Right.
Because the U.S. style scooter is going to move to the Vespa style as well, right? There's sort of, I think there's those things can feed into each other. They're not quite a strict separation between the two. NIO I know a little bit better, and again, let's just look at their share price. They IPO'd at what, 9, and now they're at 7. Interestingly, they didn't, they just lost their, who was it, their chairwoman or CEO, I believe. I don't know what to say about the rumors that they couldn't, they would have to do a down round, because if that's the case, those rumors, it wasn't just the journalists who were hearing about it, it was everybody was hearing about it. And so, they would know that. I think especially, again, like there's an advantage to going public, especially if you're involved in something like you're a car company, because it's also sort of signaling to a lot of people like, we are willing to withstand, it's like brand building as well. This is what one of the guys was telling me at a different company. It's like, why are you going to IPO? You're probably going to trade below. He's like, no, this is a great brand building exercise as well. Like, it shows that like you can trust us. Like we might trade down, but like we're going to be held accountable. Our numbers are going to be open. Like we're here to, like it's sort of you taking a stand. And so for a car company in particular, there's a lot of symbolic value to do that, right? NIO wants to be around for a while. They want to be, playing against Tesla and all that. So I think that they're, the down round rumors, I just don't know what to make of them, because as I said, like, it's not as if only you and I had heard them, right? Like everybody would have heard them. And I think that they're interesting because they're actually giving themselves a hard time, right? Like, because they're trying to sell these cars in China, and China's always such a weird market, and one day you have subsidies, the next day you don't. You're also fighting against not just, Tesla doesn't matter so much in China because they're always going to have some kind of homegrown advantage as a Chinese company, but you're up against as well the Chinese domestic automakers, which aren't going to sit idly by and wait for some upstart to take over their markets. The other thing that's happening, which is that overall China car sales are plummeting. Just the bright spot is that within that, though, electric vehicles are still pretty strong. So I think that their decision to list in the U.S. had a lot to do with signaling to, not just, there's another thing is that as a car company, you're signaling to your bankers, you're signaling to your investors, you're also signaling to all your supply chain. Like, look, we're good. You can still, we're not going to skimp you on, you know what I mean? Like if I turn to you and I say, I want to make, will you sell me a 20 million, whatever, they don't need catalytic converters, but whatever it is, tires or windshields or seats that, I'm trustworthy. Don't sell to my competitor because you don't really know what's going on with him. He may not be good for the bill because he's private. For all you know, he's going to fold tomorrow and disappear.
Might be another Faraday future.
Right. Whereas I'm listed, so look at me. I'm here. Here's my books. You can take a look. This is my cash flow. You can look on it. It's online, right? And so as a car company, there's a lot of advantages to having that. Even if your share, like your supply chain, your suppliers, they'll be concerned if your stock is, going to zero. But if it's, any given day, they won't care, right? But they will care that, I can see you have cash flow. Okay, it's been audited, right? So there's pretty high reliability that you actually were going to be able to pay me. So, okay, I will reserve X amount of my production capacity for your product, right? And that's another thing. When you're building a product, you have to, part of it is selling it, but part of it is also convincing manufacturers, the other guys, to sell to you, right? and to make you a priority so that like, oh crap, we're actually selling better than we need. Can you give me extra hubcaps? And they say, sure, I'll make my other client wait while I supply it to you first. So I think that's another reason for a company like that to go public. And it's interesting as well because they've got the venture capital arm on the side who are making some interesting plays. And they're also there. You can see like I had a talk with the head of the VC firm, Neo Capital, and their whole play was that like they want to make a national network of electric batteries, swap stations, kind of like a Better Life, right? That old business that collapsed, where you buy a car and then you sort of lease the battery or whatever, some kind of like the value of the car is in the car and the battery is a separate thing, and then you drive, and then just like instead of going to a gas station, you go to a battery station, you swap at a battery. And they think, the Neo Capital guys think that like, okay, this is a great analogy. So like when you buy a car, you don't prepay for 5 years worth of gasoline. But effectively, when you're buying an electric car, because so much of the value of the car is in the battery, you're effectively prepaying for whatever, 5-10 years worth of energy for your car. So why don't we strip that part out, and you will effectively pay for energy over the long term. When every time you go in and you swap out the battery, you pay a small fee, whatever the fee might be, whatever the cost will be. And that's an interesting model. So I think Neo, who knows? I don't know, long term what's going to go on, but I think there's interesting stuff going on there. And I think that, again, like, the short term volatility of the share price in this market's to be expected. But I think there's so much signaling that they achieve with that IPO that still will benefit them in the long run.
Yeah, I think that's the final question that we have to cover, right? Which is looking forward now, 2019. Are we going to see? Well, I think there's two really big names, which is Ant Financial and Bytedance. Are we going to see them IPO? And if not, why not?
So I think it's unlikely that Ant Financial will IPO. There's so much regulatory murk overhanging them. I think it's so complicated. And what's their last valuation was like 150 or 130 billion? Some insane number, right?
I think it's 150 if I remember correctly. But yeah, it's in that region.
Right. So they have to IPO at 200 billion at least, if not, to make everybody happy. You want 2x on the last round, so $300 billion. Let's just take a quick look at what is HSBC market cap. I'm just curious. Just like a mega bank. Hold on while I call up this number. Okay, no, HSBC's market cap is 170 billion. Okay, so they would have to be twice as big as HSBC. Let's take a look at Citibank. Citigroup, right? Citigroup is at 150 billion. So they have to be twice as valuable as Citibank. They have to be worth as much as Citibank and HSBC combined. That's an interesting way to think of it. I think that there's so much, Ant Financial's at that it's at this place where it's too big to fail right now, right? Because it's essentially built infrastructure. It's now a financial infrastructure company, right? And you know how the Chinese government feels about infrastructure. It's a national security issue, right? Bridges, roads, highways, telecoms, and now they have built a national pipeline for money to flow around, and they're going to regulate that to the micron, right? Like that is so crucial now to the functioning of the economy that it has to be super, super closely regulated and super, super closely controlled, right? Because, you can't, like one of the most powerful levers that the Chinese government has to exert control over the economy, and by the way, like it's clear that this environment is much more, it's not a free market environment, right? There's definitely a clamp down and a tightening of the reins and more of like putting the state first, and it's just sort of the pendulum has swung, right? And so, Ant grew at a time where things were getting looser, but now things are definitely getting tighter. And one of the key levers of control over the economy has been the banks, right? The big four. because that's how you control lending, right? And through interest rates, and even just telling the banks, you will lend to these kinds of projects. And so you can't suddenly allow this mega entity to have sprung up in private hands alongside that you can't control, that can like undo all of your financial policies. So for example, like the peer-to-peer lending platforms that just exploded and were abetted by how easy it was to move money through these new digital payment systems, whether it's WePay or Alipay, right? A lot of the transactions into P2P platforms were flowing through these Alipay and Tenpay. And it was a disaster, right? Initially, it's like, okay, this aligns with our policy because it's helping fund small and medium enterprises that were shut out of the traditional banks. But then it turned out to be just a giant fraud. And now there's this massive cleanup campaign, right? But it's all retroactive. Like it happened before regulators even knew what was going on, right? And suddenly you have these like massive, $9 billion Ponzi schemes that explode overnight because there's this frictionless movement of cash through these new systems that have arisen. So I think that's going to make, okay. Now that said, the four major banks, the four state-owned banks in China are in fact listed, but they're listed in a very, I think a very minority, whatever. I think the float as a percentage of overall shares, I think is quite small, relatively speaking, but they're still substantial. So I think that is a potential thing that could happen. The other thing is that like when you go to list this thing, the due diligence you're going to have to do to figure out like what are the regulatory risks. It just seems like it's such a, I don't know. I think 2019 is not the year for Ant to go public. The other thing is that like their global expansion plans, the U.S. is just off the table, right? Like that's just not going to happen. They won't be able to expand into the U.S. Europe now is looking more and more sketchy because of sort of this paranoia about China, whether it's legitimate or unfounded. It's still just like for them to start moving into Europe is going to be more and more challenging. Southeast Asia, sure, Paytm is doing really well in India, but even there, like now they're going to be up against Google's payments platform there. Amazon is probably going to is going in there as well. So I don't know. I don't think Ant is going to be. Their story now is one of uncertainty, and I think it's a hard sell. Bytedance, I think, will probably list because they're to me they're a momentum play, and they've got crazy momentum right now, right? Like TikTok, oh my God, it's growing so fast. I think that all it is a momentum play, and soon that momentum will peak, and then so they better list sooner rather than later. And I think people will pile into it because it's like, oh look, it's And to be frank though, I've heard good things about Bytedance. Although even though I think that anything that's viral, I think, oh, MySpace, I remember that company well. Especially one that doesn't have the social aspect of like a Facebook, like where you're not really vested in its continued existence, right? Like I'm vested in Facebook because all my baby photos are on Facebook, and that's how I show my mom my baby photos. I'm not vested in YouTube, right? YouTube could vanish tomorrow for all I care, and I'll just look someplace else for the videos. I think that's the weakness in something like a Bytedance or a TikTok. That said, what's interesting, what I've heard about Bytedance that's really compelling is that, first of all, their advertising revenue is real. It's real money. It's in the billions of dollars. It's growing strong. And the reason it's growing strong is because advertisers are happy giving their money to Bytedance because they found that the return on investment, like the number of clicks they get, the number of sales they make for putting an ad into a Bytedance platform is much better than they would get into other platforms. Now, I don't know if that's true. That's certainly true in China where, okay, you're up against what? Tencent, which is kind of like the WeChat Moments has kind of not been fully utilized to its full potential. Baidu, which whatever, right? I don't know if that same efficacy of advertising would still be true if they're competing against Facebook in Southeast Asia or in India or in the US. But within China, though, Bytedance seems to be like a really, like advertisers love it because they're making more money on their ads in Bytedance. So I think that they still have a good story to tell, a great story, right? And can you imagine if they launch another blockbuster app? What's also interesting is that Bytedance has shown that their addiction algorithm works overseas too, which is really interesting. I think in terms of like, they're the first Chinese company to have done that with a cultural product. Huawei is truly a Chinese international brand, right, through its phones and infrastructure. Xiaomi to some extent as well, but when you look at how like other kind of social networks or cultural products, whether it's film or something like a WeChat, haven't succeeded. It's really interesting that Douyin has figured out how to sell. It's figured out like the deep DNA for culture addictiveness. In India, they're doing decently. They're showing real growth. So I think that's what's compelling about them.
Yeah, I mean, for Bytedance, I agree. The advertisement on the newsfeed is compelling, full screen video, so I can see why it would get better results. Interesting what you said about the revenue. I've done my own calculations. I think their model is very similar to Facebook, and it certainly can be very profitable. I mean, it's a newsfeed model, right? So it's really like getting the new user in the door on a very low cost, and then like feeding them ads over time. It's really, really, really similar. And I don't see them. I think for them, you're right. They've got a lot of momentum right now. So for them, the question is, can they break the US market, which they're trying to do right now? And if they can, then their valuation is going to be even larger than it is right now, significantly more so. So for me, I think the question is, can ByteDance actually do that as a Chinese company, right? I think their product's compelling, and the algorithms, as you say, like are culturally neutral, I guess you could say. The product works in all different kinds of markets because it's short video is a compelling user experience, and nobody's doing it well outside China right now.
Yeah, I think for me, the biggest risk is regulatory, because you're in China, you live or die by the Communist Party, right? Like, because they're unlike commerce, communications, propaganda, that's core party function. That's one of the things that the party thinks it needs to control in order to maintain its control, right? Or it's like, this is how it communicates to the masses, right? This is like one of the things that builds the Communist Party. And, they are always skirting on the edge. There's that fine line between interesting and illegal or interesting and banned. And I don't know that at some point, like the Communist Party or the cybersecurity regulators say like, we think you're too fancy, or you're, just like what they did with video games. Like, these are video games are now a corrupting influence on the youth. Boom, you're toast, right? You can see how damaging regulatory, right, the impact on Tencent. Like the government's like, games, we don't think they really uphold the spirit of the Communist Party. Kaboom, right? And so you've got a company, like at least Tencent, it's got other stuff, right? Okay, so we're losing revenue on the games, but we have other, we have our social network, we have this, we have that, we can pivot to businesses. Bytedance, oof, right? So on the one hand, it's like, they'll be worth so much more if they break into the US market. Also, they really need to break into the US market to diversify their regulatory risk.
Sure, and also they need to take on Facebook, right? The only company, the biggest risk for ByteDance internationally is Facebook cloning them, as doing a Snapchat.
Exactly.
But Shai, so I think that's about all the time we have. But as always, thank you so much. And if people want to find you online, where can they do that?
I'm at Shai, SHAI, at theinformation.com. Our website is theinformation.com. It's harder and harder to read us. We're subscription only. So if you want to read us, you got to subscribe. But now, 5th year anniversary is a great time to be a new subscriber. We've got lots of good introductory offers. And if you hit me up personally, I can maybe hook you up with an even better deal. But definitely, I think our coverage is really, if you want to understand Silicon Valley, if you want to understand tech, increasingly if you want to understand Hollywood, and soon if you want to understand what's going on in DC, policy tech, you got to be reading the information. I'm so proud to be part of this team of psychotic workaholics. But yeah, so again, Shai, S-H-A-I, at theinformation.com. I'm also on Twitter, at Beijing Scribe, because I used to be in Beijing when I launched my Twitter account 10 years ago. Yes, I'm in fact old. I'm also on WeChat, Signal, Telegram, Fax, Smoke Signal, Stone Carvings, and Reiki.
And that's about all the time we have for this episode of China Tech Talk. As always, thank you so much for listening. And if you enjoyed this episode, we'd really appreciate it if you gave us a review on iTunes, or you can go to Overcast or Pocket Cast and tap on that star button, and it will recommend this episode to your network. Also, we are on Himalaya and Spotify, so you can find us there if you haven't already. And also a quick reminder, TechNode, we do several newsletters every single day, including a curated summary of technology news in China, including some of the stuff from us, and a thrice weekly newsletter looking at significant fundings over the last couple of days. You can go to technode.com/newsletters to subscribe.